For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll discuss tax-smart investing strategies for those nearing retirement, life events that can trigger liquidity issues, and then finally, financial moves to make before year's end. My name's Jeff Shade. Of course, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Randy, how are you this morning?
Doing very well, Jeff. How about you?
I'm doing fantastic. And hey, Jake, how's this weekend finding you, my friend?
Doing great, Jeff. Thanks for asking.
Always glad to hear it, you guys. Hope everybody's having a great weekend. And as always, we really do appreciate you listening to us each and every week here for Show Me the Money. Well, let's start with current events, guys. The markets have reached record highs amid optimism on rate cuts. What do you make of all of this? And does it look like it's going to continue here for the near future?
Yeah, Jeff, I think that the future is pretty bright, actually, especially short term. I've kind of been predicting for the last 6 months or so that I thought the S&P might hit 7,000 by year end. And then, lo and behold, there were some other people that have big staffs and people behind them that do all sorts of research that came along and said the same thing, So who knows? I don't know if that's a self-fulfilling prophecy or not, but basically we saw a little bit of a sea change with the rate cut that we had here a while back, and we think we're probably going to get more. And I think the market sees that and is looking forward.
When you're talking about people, is it staffs or staves? I'm not sure.
I like staves. I like staves. We're going to invent that as
I'm going to ask AI what we should do there next time, but carry on.
Okay. Well, gold is another thing that I want to talk about here, too, that gold, it just keeps going and going. Really, this rally shows that investors still want to hedge. What do you make of that?
Well, I think, too, that there's a couple of schools of thought out there. One of them is that William Devane is getting the job done on that commercial.
I think Bill Devane made those commercials probably, 15 years ago. But, yeah, I know what you're saying.
But other than that, and I don't want this to come across wrong, but to me, the gold play is just simply a fear play. That's how I see it. And so there's apparently quite a bit of fear out there. And then, of course, the market play is we're bullish, thinking that things are good, and the thing we have to remember that anytime we're looking at investments and building strategies, there's always those people that are buying, always those that are selling, and they both think they've got the right idea.
I think, too, there's kind of an overlay, though, of the Fed, right, where gold can do good, stock can do good, bonds can do good, crypto can do good, real estate can do good, all at the same time if rates are coming down. And because all those things are doing good, really, at the moment, or at least they're stagnant to positive, maybe on real estate, but everything else is going up, I think it's evidence that we're pricing in future rate cuts here. And if we watch our Fed Watch tool, it's starting to look like the market thinks 3% is the neutral rate, which over the next 6 or 8 months we'll probably try to steer towards. So that would be 4 more rate cuts as this show airs. Obviously, that's going to shift as the situation shifts, but I think that what we're seeing largely is 2 things. Too much lazy money, too much money market money, too much savings money, too much hedge fund money sitting on the sidelines, number 1, and that money's starting to go to work. And number 2, the pricing into those rate cuts is really affecting all asset classes. So I agree with Randy on gold, but I would say this. It doesn't mean that gold can't go higher from here. And if we really start to cut rates, gold probably will go higher. The question is do we want to own gold? Do we want to own stocks? Do we want to own real estate? Do we want to own crypto? Do we want to own bonds? And the answer to that question is it depends. Like so many questions we answer on this show is it depends. And I think it depends on what stage of life you're at, what stage of retirement you're at if you're retired, what your goals are, whether it's to live your fullest life or to leave a legacy to your kids or both. There's a lot of things that come into play here. Just know that we can use just about any asset class out there. Whatever makes the most sense for our clients is what we want to do. We have a fiduciary obligation to act in your best interest. And in my opinion, unless you can offer all those things I just talked about, you can't fulfill a fiduciary obligation, because what if the best interest of your client calls for something that you cannot offer to your client? That's kind of a problem. So that's why it doesn't say Merrill Lynch on the front of our door or some other major firm, is because I don't want some ivory tower telling us what we can and can't do for our clients.
Randy and Jake, let's get back to the market right now. S&P 500, NASDAQ just hit record highs. With high valuations, though, there is a higher risk of correction. How should we prepare for that if and when that should happen?
You know, Jeff, that's really always the $64,000 question.
Right.
People come in and say, so can this market go higher? Yes. Can the market go down? Can it stay the same? Yes.
Yes.
You know, it's just, we have to live in the world, though, here where the world keeps spinning and everything keeps going. Now, there's a lot of problems across the globe right now, right?
Mm-hmm.
In fact, Jake and I, we just happened to have a conversation the other day about this over the phone. I just said, I think, Jake, what we're seeing with a lot of this turmoil and stuff may just be a new level of normal for us for a while here, and maybe for the foreseeable future. I would love to think that things would calm down. I do think this, though. I think that investors and economies and people have become almost shell-shocked to where nothing really affects them that much anymore. Now, make no mistake, there will be something that will precipitate a downturn in the future somewhere, but I will tell you that looking forward, with the amount of money that was put into the system back in 2020 through 2022 and where that money is sitting and things, and if we push rates down, people are going to look for a new home for that money. So I think the markets have room to run.
The markets now expect the Fed to cut rates in October and maybe even again in December, guys. How could that play out for stocks, bonds, and income-oriented retirees?
Again, I think that it's going to force people to rethink maybe where they've had CDs at 4.5%, maybe even 5%, looking back over our shoulder 6 months or a year. They're going to have to rethink where they're taking that money from, because all of a sudden, if banks get down to 3 where they've been used to 5, they've lost 2%. On $1 million, that's $20,000 a year, $1,666.67 a month. They're not going to have to spend. So they're going to have to start looking for a new home for some of that money, and they will.
I think those rate cuts are almost a virtual certainty at this point. I mean, we're talking 95+% that those 2 rate cuts happen. The question is, do we get another one in January? Do we get another one in March? Those ones are not really set in stone yet, but I think the 2 remaining this year, it's going to be really hard to make the case that we don't need to cut those, especially in light of the jobs numbers and things. Now, last week we did not have our jobs report because the government was shut down. However, it's speculated that the jobs number would have been negative, maybe even significantly negative. So I don't see how the Fed cannot cut rates here this next 2 meetings. So if that's the case, then there's going to be very little to rear its ugly head between now and the end of the year. We're almost into earnings season here. Earnings season is this coming week. Those numbers are going to look really good for most companies. And then before you know it, we'll be at Black Friday, and then it'll be off to the races for retail, and we'll get to January, and then we'll have to kind of take a hard look around and say, all right, we've had a humongous run after April of 2025. Where are we at? What are we expecting to have happen next? And that remains to be seen at this point.
Talking with Randy and Jake Floyd of Floyd Financial Group. We're talking about current events. Again, our phone number, 417-889-7233. You're listening to the program this morning. You'd like to get in and sit down and talk with Randy and Jake. It's obvious that they have a firm handle on what's going on in the market and the economy. If you want to know how that affects you and your journey towards a prosperous retirement, we'd love to help you. No cost, no obligation for this consultation whatsoever. Just a very casual conversation, sort of like visiting with an old friend at 417-889-7233. Also online at floydfinancialgroup.com. Talking about these Fed rate cuts, we had 25 basis points here in September. Are you expecting a quarter point here in October, maybe another quarter point in December? And if we get into January, maybe another quarter point. We could be down by 1 point. What do you think? And I know we don't have a crystal ball, but what's your prediction for the rate cuts in October and then later on in the year?
Yeah, I think we're a couple of weeks out, I guess, from our next Fed meeting. And I think, yes, that we will have a quarter point cut. There's 12 Federal Reserve banks, and then we got the chairman, and each of those has a president, and they all have their vote, and then they try to get consensus on what to do. I think we have a few dissidents, if you will, that are saying, hey, we don't want inflation to raise its head again. The data has been a little bit, I won't say it's conflicted. However, what we did see was we saw the consumer price index I think the last time we really looked at it, it was a little hotter than they wanted. However, following that, we did see the producer price index was negative 0.1, so that's going to probably filter through. The other thing that bears talking about is the fact that prior to COVID, when we were trying to get to 2% inflation and we had zero interest rates, we were doing fine. The economy was growing great at 3+%. So just because we have low interest rates does not necessarily mean that we're going to have inflation. So I think that's really important to factor all this in, because some people will want you to believe that as soon as we cut interest rates, we're going to have inflation again. And I just don't know that that's true. In fact, I think it might be the opposite. I think what it will do is free up capital for small business to introduce maybe new competition to larger businesses that have had deep pockets that haven't had to suffer as much through this high interest rate environment.
And the question is, will Trump and the FTC and everybody let Amazon buy up those companies as they become competition? That's
right.
And so far, we have not seen anybody in the Trump administration wanting to push anti-monopolistic or antitrust types of lawsuits and things like that. So I think the answer to that question is probably yes. There's some of the market pundits out there that seem to think that the large tech companies have seen their day, but I don't think that's true. I think they're going to continue to be, pushing forward. One of the things I talked to a client actually yesterday about, we were discussing the Magnificent Seven and these big tech stocks. And ultimately, if you think the market is going to keep going up, then you have to think that big tech is going to keep going up, because the market really can't go up without big tech going up too. And so if you have a hard time seeing big tech going up more, then it's going to be pretty hard for the market to go up more. I don't think you could hold both of those separately, those beliefs.
I agree. I mean, big tech is what percent of the overall market? I mean, we're looking at NVIDIA is probably 8.5% now of the total market.
Yeah, it depends on how you define big tech, but it's somewhere between 20 and 30% of the market.
So if it doesn't grow or if it goes negative, it's going to be hard for the other stuff to pull it up.
So looking ahead, Randy, what are the big things that investors and retirees should watch for in the coming weeks?
Yeah, for sure. There's a whole lot of stuff out there, right? Everything from geopolitical stuff across the Middle East and all the stuff that's playing out across Europe and all the rioting and things that are going on over there that all have a little bit of effect on people. Of course, the Fed decision on cutting rates. We've got earnings season coming up. Is there going to be an inflation surprise or not? I think probably not, but we'll see how that shakes out. And of course, we're looking at valuations and sector rotation in the marketplace. Right now, the stock market in general, how is that going to shake out? Of course, that's going to be derived largely from earnings season.
You're listening to Randy and Jake Floyd, Floyd Financial Group. My name's Jeff Shade. Our show, of course, is called Show Me the Money. We really appreciate you making us part of your weekend. Again, if anything that we have said today piques your interest, you want a little bit more information and some guidance towards a prosperous or a confident retirement, we are offering that at no cost, no obligation. It's just a casual conversation. You can get yours right now by calling 417-889-7233. Simply leave your name and telephone number. Ashley will call you back during the week. She will set up a convenient time for you to come and sit down, talk with Randy or Jake, get some questions answered, and put you on a path towards a confident retirement. It's not going to cost you a dime, no obligation, no judgment. We'll meet you where you are. 417-889-7233. You can also visit us online at FloydFinancialGroup.com. Randy and Jake, we're going to take a break. When we come back here on Show Me the Money, we'll be talking about tax-smart investing strategies for those nearing retirement when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about tax-smart investing strategies for those nearing retirement.
That's right, Randy. If you're nearing retirement, you probably worked hard and you've saved and you invested, but the truth is, what really matters is not just what you make, it's what you keep after taxes. And today, we're going to be talking about tax-smart investing strategies that can make your retirement savings last longer. So, why is it so important, Randy, to think about taxes when planning for investments in retirement?
Yeah, for sure, Jeff. I mean, the thing that we always have to look at is while we're working and we're saving money, We're trying to do as much of that generally tax deferred as we can through our 401k plan, our 457 or 403b, depending on what kind of entity you're working for. And most times it makes sense that, yes, we're going to pay more in taxes while we're working than we are after the fact. However, we just need to be cognizant of the fact that we are going to be paying taxes in retirement. Sometimes people think that, well, they don't tax Social Security. Well, that's not true. They do tax it at the federal level. Now, here in Missouri, we did get the reprieve on taxes on Social Security at the state level here. So that's good. That saves people as much as maybe 4 or 5% on their Social Security tax. But, we need to always be cognizant of the fact that we are going to be taxed. And does it make sense to pay taxes now or pay taxes later? Because we have different tools that we can invest in, not just two. But a lot of people think, well, there's just two, right? There's a Roth 401k and there's a traditional 401k. But no, we have everything from municipal bonds, which can be tax-free bonds, to money market accounts, to brokerage accounts, to standard retirement accounts, all the above. And all those things, or many of those things, are taxed at different levels and at different rates.
Let's start with retirement accounts. Randy, how should people nearing retirement think about traditional IRAs versus Roth IRAs?
Yeah, so let's talk a little bit about what those are. So the traditional IRA or the traditional 401k, you're going to put money in pre-tax and you're going to deduct that from your taxable income this year. If we put money into a Roth IRA or 401k, we don't get any tax benefit today. We go ahead and pay the taxes and we invest with after-tax dollars. But after we have that Roth account open for 5 years, all the earnings and all the growth will come out of that thing at 5 years and 59 and a half, I should put in there. All of those earnings and everything will always come out tax-free. In fact, it doesn't even generate a 1099 or any type of a reporting document to the federal government. So it's one way to really be sure and look forward and say, I'm going to be able to mitigate taxes. Now, the challenge is many people have already saved a lot of money in traditional IRAs and 401ks and hadn't thought about the Roth. So we have to always look at doing what ifs and does it make sense to try to do that over a year or two or three? And I would say that generally it does not. Many times we need more time than that to be really effective at converting if we've already saved a bunch of money in traditional IRAs and 401ks.
Randy, I'm sure that a lot of people listening have taxable brokerage accounts. Are there strategies to reduce taxes on investments held there?
Sure. I mean, of course, you can hold stock and stuff for a long period of time and not realize the capital gains. Of course, we have short-term capital gains. That means anything I've held outside a retirement account for a year or less, any gain that I make there is just ordinary or standard income tax. If I've held it long-term, 12 months or more, that becomes a long-term capital gain and has different tax treatment. For most people, that's going to fall into the 15% bracket for the Fed. Some states, like Missouri, capital gains is going away here, so that's going to be a good thing for us. We also have, in a brokerage account, we have dividend-paying stocks, and we have qualified dividends and non-qualified dividends, and depending on what tax bracket you're in, some of those you will not pay any taxes on those dividends. So yes, there's many, many things to consider, and we could actually talk about this for probably the next 2 hours, but I won't bore people with that. All I would tell them is we need to think about how we invest money. Mutual funds are one of those things, and that there's literally tens of thousands of different mutual funds that you could invest in, either in a 401k or an IRA or outside in a brokerage account. But one of the things that we like to use here are these things called ETFs, exchange traded funds, because they give us more room to work with taxation because we get to control the capital gains taxability of that stuff. Whereas if you have a mutual fund, the mutual fund company decides that. Also, the ETF allows us to trade right now on the spot versus mutual funds at the end of the day. So there's just many, many things that come into play when we start looking at which investments to use for tax efficiency versus what's taxable, right?
And Randy, I had to chuckle a little bit when you talking about taxes for 2 hours. I think if we did that, the rate of automobile accidents would go up here in Springfield and people driving off the road. Taxes are not the most scintillating topic to be talking about on the radio, but they're so important because when you really think about expenses in retirement, two things jump out. Taxes, I think, number one, healthcare, number two. Are they in that order or is it reversed?
No, I would say that's right. The taxes come up first. Not because maybe it's more important. I don't know that it is actually, but it does come up first because people are living that right now. The health thing is pushed down the road, right? It's also important we should talk about the fact, if you have brokerage accounts and you've got lots of gains built up in there, you may have some losses in there as well that need to be looked at. So there's ways to maybe offset certain gains with losses when you start to pull income down the road.
And remember, Uncle Sam is always there. He's reaching out. He's looking over your shoulder. He wants his taxes. Talking with Randy Floyd Financial Group. Of course, we have our office right here in Springfield. 417-889-7233 is our telephone number if you'd like to be in touch with us and get it and sit down, have a conversation with Randy or Jake here at Floyd Financial Group. No cost, no obligation, no judgment. Once again, it's 417-889-7233. Randy, required minimum distributions, RMDs, are another tax hit that retirees face. How can someone prepare for those?
Yeah, basically, Jeff, what it amounts to is any money that you put into a retirement account that has been tax deferred, like the traditional 401k or IRA. If we look at that, at age 73 is the current age, you have to start taking what's called the required minimum distribution. Now, that's going to go to 74 and 75 for some of the people that are listening right now, and who knows where that will go. Ultimately, they've changed those rules 2 or 3 times now since 2020 with the Secure Act #1 and then 2.0 that they did. But RMDs sometimes are kind of a surprise for people because basically when you first start taking your RMD when you hit 73, it's a little less than 4% of your account balance. So if you got $1 million in a 401k, you're talking about 40 grand that has to come out, and that's going to generally push people into another tax bracket. So one of the things that we can look at is people say, well, I really don't need the money. So what can I do since I have to take that out anyway? Can I take that money out, pay the tax, and reinvest it somewhere? You absolutely can. Can I give that to a charity? You absolutely can. In fact, there's this thing called a qualified charitable distribution that you can do that allows you to take that distribution directly to the charity, and it never, ever hits your tax rolls. So it keeps you maybe in a lower taxable Social Security bracket as well as just overall income tax.
You had mentioned QCDs, and that's charitable giving. Are there other ways that you can contribute to charitable causes or help other people out that will, in the end, certainly have a benefit for you tax-wise?
Yeah, there's charitable trusts and several things that are a little bit too complex for what we're going to talk about here off the top of our heads. But yeah, there's lots of things that can be done. Now, the thing that I would say about QCDs and RMDs in general, so we have a few people that are listening to the show today that would say to me, you know what, I will never, ever, ever need any money out of my IRAs or my 401ks. However, most people are going to need some distribution out of there. So when we start looking at how we take income, when we first set up income strategies from Social Security, maybe if you're lucky enough to have a pension, and then you've got investments, and maybe you got a brokerage account, and maybe you got CDs, maybe you got cash sitting in a savings account. We have to look at all those different things and kind of add them up together and get us to the level that we need for income to live on. And then we kind of have to look at what is our most tax efficient way to do that, and which account do we want to spend down first if we're going to spend an account down. So withdrawal strategies are a real thing, and it's something that people need to really understand their tax picture before they enter their first month of retirement paychecks.
Randy, I'm sure that a lot of people listening to the program right now have large purchases in their future. How does that play into our conversation about taxes?
Yeah, for sure. So a lot of times people will call me up and they'll say, Randy, I'm getting ready to retire. I got my 401k over here. I owe $150,000 on my house. I've got a 3% loan. I want to go ahead and pull that $150,000 out of my 401k and pay my house off. Now, a couple things I want to say about that on the front end. Number one, there's the emotional side of things when we invest and talk about paying bills and things like that. And then there's the practical financial side, right? So the thing to consider is this. Yes, you'll be rid of your house payment, but if it's $150,000 that you owe, it's probably going to cost you 30% more to pull that money out. And it could be, in many cases, much more than that, but it could be as much as 30% more that it's going to cost you. So add another $45,000 to that $150,000. So you're talking about pulling out $200,000 from your retirement account, and that money's gone. Now, yes, you got your house paid off, but here's the thing I would say is, if you're going to do that, let's do it in a couple of steps rather than one big one. Maybe it's October, November of the year, we pay half, then we pay half into next year to get it to 2 tax years. Or better yet, let's just let's keep our 3% interest rate and let's see if we can't
Right.
grow our money a little bit more and save that 30% and keep that 30% working for us. Now, the house thing is a little different than in most cases when people call up and they say, hey, I really want to buy a new car. And Randy, I'm retired and I just hate monthly payments. I don't want to do that. I say, well, I understand that monthly payments can be a problem, but I'll tell you, we can automate those things for you.
Yeah.
And I said, in today's world, too, we can get really low interest rates on new cars right now. In fact, there's 0% right now for 72 months on cars. People say, yeah, but, I don't really want to finance. Well, here's the thing. The average car today is probably $50,000.
Oh, yeah.
So if you take $50,000 and you add that to your current income, it may put you to where you're paying 25% by the time you get federal and state tax in there in taxes. So you figure if it's a $50,000 car and you pay 25% tax on that, that's $12,500. And if you get 0% financing, why would you not do that and keep your money working? Number two, the other thing I would say is too, when you put it in a car, what do we know about the car?
Right. It's going to depreciate.
Now,
Yeah.
listen, I'm not telling people that you can't pay cash for a car. If you want to pay cash for a car, that is totally up to you. However, it is part of our job here to make sure you make and we show you the best way to make these financial decisions. Now, on the emotional side, if you have a debt that you just don't want, you want to pay it off, that is totally up to you, and that is fine. It's your money. We're not going to tell you what you can and cannot do with it, but we want to give you good, solid advice that's going to keep you safe and keep your money growing in your account rather than somebody else's.
Great advice, Randy. And, taxes may not be the most exciting topic, but they can make or break a retirement plan. So if you are listening to the program today and you want a little help creating a tax-smart investment strategy, you can reach out to us here at Floyd Financial Group by calling 417-889-7233. You can do it right now if you want to leave your name, telephone number. Ashley will call you back during the week and set up a time for you to come in and sit down with Randy or Jake here at Floyd Financial Group. The great thing, it is not going to cost you a dime. There is no obligation. We have no sales training here at Floyd Financial Group. We just want to help you. And certainly there is no judgment. We'll meet you where you are. We all put our pants on one leg at a time, as Grandma Maggard used to say. 417-889-7233 is our telephone number. Make that call this weekend, won't you? You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, let us take a break here on Show Me the Money. When we come back, we'll be talking about events that can trigger liquidity issues when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
With recent sharp increases in government spending and a U.S. budget deficit in the trillions of dollars, it's no secret that tax increases may be in our future. Inadequate tax planning could derail your quality of life in retirement. Floyd Financial Group in Springfield knows this. That's why accounting for tax increases is a big part of the retirement plans they build. They're looking forward in your tax future to find opportunities to reduce your taxes wherever possible. Wouldn't you like to know that you're not overpaying on taxes? If you'd like to talk about a retirement plan that could last 30 plus years and includes a tax minimization strategy, call for your no-cost, no-obligation, no-judgment financial review at 417-889-7233. That's 417-889-7233, or request it online at floydfinancialgroup.com. That's floydfinancialgroup.com.
Floyd Financial Group, LLC is an SEC-registered investment advisor.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about events that can trigger liquidity issues.
And Randy, to start off, when we talk about liquidity issues, what exactly do we mean in terms of personal finance or in a business context?
Yeah, so if we have maybe an unexpected bill, maybe a medical bill, $20,000, or maybe it's a roof on the house, or we've wrecked a car, and people say normally we have a low deductible and that sort of thing. But yeah, things that come up that you don't anticipate that, in today's world, it's easy to have a $10,000 or a $20,000 bill that you didn't see coming. It's just crazy how expensive some things are.
Exactly. And as you said, a car repair, a transmission, $4,000 or $5,000. I mean, also medical bills. Many people have deductibles on those. They can be high deductibles. It's not uncommon to go into the hospital, come out with a $20,000 medical bill. So liquidity is simply the ability to access cash when you need it. And you might have wealth on paper, your home equity, retirement accounts, or maybe even business assets, but you can't convert that into spendable cash quickly without taking a big loss. That is a liquidity issue. Now, these liquidity issues, they don't happen on a schedule. Have you ever had anything that just all of a sudden jumped up, Randy, and you needed $20,000, $30,000, $40,000?
Yes, I mean, I think most of us have experienced things of that nature, and sometimes it's from something that's maybe happened to one of your kids or a relative or somebody like that where you want to help them out.
Or now it might even just be an air conditioner or a heater.
That's right. It could
Insane
easily
how
be
much
that.
that stuff costs now.
It's kind of crazy. I had this lady in not long ago, Jake, and she was looking at replacing her HVAC system. And she had bids from $7,000 to $30,000 for the same, the same house. And you're talking about just a normal house, about 2,000, 2,500 square feet. So, yeah, I mean, it's crazy the things that can happen. And that stuff is just stuff that you can't see. Now, some people say, I have a home warranty, or a lot of the people listening here today has probably seen Danica Patrick and those people on there talking about endurance. Who's going to pay for your next car repair? You or endurance?
Or endurance, right? Well, I got something to say about that. But anyway, I'm not necessarily endurance, but I'll say it after you've said your piece. Go ahead.
But anyway, yeah, there's things that come up. And, people just like to have the peace of mind of knowing that if something like that comes up, it's not going to be a lump in your throat moment or that little sharp twinge you get through your body, that comes up. I had one guy one time says, Randy, I can't sleep well at night unless I know I can lay my hands on 200,000 at first thing tomorrow. And I'm thinking, well, that maybe is a little extreme. I don't know, but for some people, probably not. But for me, I thought, well, I don't know that I need that much. But for people to have 3 to 6 months liquidity on hand, I have no problem with that. In fact, I encourage people to have 90 days because things can and do go wrong. And we want to make sure that we're able to handle those things and not be stressed out about it when they come up and not have to reach into maybe a pile of money we're in a market decline or something, or things have been not good, and we don't want to have to reach into a depleted fund to do that. So I think having some ready cash on the sideline is always a good thing.
And you talked about those auto warranties. Now, I can't say the way that they do it today, but I remember checking into an auto warranty some time ago, and the way that it works is, yes, we will warranty these particular repairs up to a certain point, but I ran into 2 problems when I investigated further, one of which is that you have to go ahead and pay the bill. They won't pay it directly to the mechanic. You have to pay it, and they'll reimburse you for it. And then number 2 is if they do pay it directly to the mechanic, you've got to find a mechanic that's a participator who will take that insurance payment. It's not always that easy. It can be a great solution for some people, but for other people, I think the thing to do, as you said, is to have liquid cash lined up and realize that automobile expenses are very expensive at times. And I'll say this, it's always cheaper to repair than replace. So, keep in mind a transmission could be $3,000, $5,000 easily. You've got an engine can be $5,000, $6,000, $7,000. Automobiles are not cheap things. Talking with Randy Floyd Financial Group, we're talking about liquidity issues here. And we've talked about all the things that can go wrong. So let's talk about how we can make things go right. What are some of the ways that we can prepare for these liquidity issues in terms of ways that we can hold money other than just a checking account?
We see money market accounts have been pretty good here of late. For the longest time, if we look back over our shoulder, when interest rates were so low, when home loans were 2.9 and 3.25%, I mean, banks weren't paying anything on CDs, or they weren't paying anything on money market accounts or savings accounts. Back like when I was growing up, if I remember, we used to get 7 and 8% on savings accounts. We had a passbook. We go in and we'd make our deposit. They'd write down in there and stamp it. Randy put in $10, and your per annum, your APY is 8%. I remember those days, but boy, we haven't seen those in a while. There's lots of ways and lots of places to put money today, but I would say this too. In today's world, there's all types of investments. Some are more liquid than others. So if you have money in stocks or in a brokerage account, that money is really pretty liquid and usually within a day or 2. If you have money in things like real estate investment trusts, not the case. If you have things in certain annuity contracts that are really screwed down pretty tight as to what you can get there, especially if you've gone through committing a annuicide, we call it, and you've annuitized an annuity, you don't have any liquidity left there. But for the most part, it's going to be checking, it's going to be saving, it's going to be money market, it's going to be the stock market. Those things are going to be your liquid places. You can't really go, and I guess you can get a home equity line against your home, maybe potentially, but you really don't want to go down that road unless you have to, because that's always subject to changing interest rates, and it can be pretty high depending on what goes on with the underlying interest rates and the prime rate. So again, the biggest thing I would say is stock market, money market, checking account, savings account is where those liquid assets need to be so they're easily accessible.
And as you mentioned, too, lines of credit, you can get a home equity line of credit. I guess they call it a HELOC. It's easier to get approved, though, when times are good than when you're already in trouble. Have you found that when you need money, Randy, you can't get it? When you don't need money, everybody's willing to lend it to you.
Jeff, that's the reason that the stock market exists, right? If a business owner really needs money, he can never get it. But if you can find some people that are an investment banker, that's what they do, right? And that's why we have the stock market.
Talking with Randy and Jake, Floyd Financial Group, we're talking about events that can trigger liquidity issues. And again, you have questions, 417-889-7233. We're looking to put some money away so that when unexpected things do happen, you've got the money to pay for it. I want to back up here a little bit and talk about some ways to prepare for liquidity straining events. You talked about an emergency fund, and as you've said, I've heard 3 to 4 months of expenses in liquid cash or cash equivalents. If you are a retiree and you're not getting a regular paycheck from someone else, you're making your own paycheck, would you say that you should have more money in a liquid account, let's say 12 to 18 months? And how much is too much to be setting aside?
Yeah, I'm going to tell you that generally speaking, we think that 6 months of liquidity is enough. We want to be careful with how much of our investments we tie up in something where we can't get money out. Now, we have a lot of people around here, especially around Southwest Missouri, a lot of people with rental property. And, as long as you have a good nest egg, and some of those people will have more than 6 months because they know they may have insurance claims, they may have to remodel, they may have to replace carpets, they may have to paint, they may have to do all those different things. But for the average retiree, I'm going to tell you that 6 months is generally enough. Now, the one thing to consider is, what are my options if I have a major health crisis or something like that? Are there are ways for me to get access to that money if that should come up? And generally, if you've got 6 months to figure out a plan, the answer to that question is yes. But again, I would always tell people, if you have a credit card with a pretty good limit on it that you don't usually use, you're going to have a line of credit there maybe that you can use to help get you down the road a little bit as well if it has to go beyond 6 months. But generally speaking, you can get access to cash and sell something over a 6-month period. So I figure that that's probably enough as a liquid reserve.
Okay, so 6 months of expenses we recommend, and those are 6 months of living expenses, but I think a lot of people underestimate what it costs them to live, too. They say, well, $4,000 is what it cost me a month to live, times 6, $24,000, when in reality they're spending $6,000, $7,000. So you gotta be pretty real about that, don't you?
Yes, absolutely you do. And that's one of the things that we always do when people come in, either if they're retired already or if they are thinking about retirement. We're always looking at what are your budgetary requirements to keep the family fed and keep the wolf away from the door, and then what is it that you want to do in addition to that to have some fun and enjoy retirement. So there's where we come up with the actual number that we need times that 6 month.
Right, and you talked about using a home equity line of credit. Some people will use credit cards as a means of backup, but these days credit card interest rates are nearing 30%. Now,
Yeah.
I've got a card that has a high limit on it, and I really never use it, but the interest rate was almost 30%, so I gave them a call, and I said, how long have I had this credit card? They said, well, Mr. Shade, oh my gosh, you've been with us for 20 years. I said, well, considering that, is there any way that we could lower that interest rate? They said, just a moment. Ask and you shall receive. It went from something like 28% down to 15%. So you can reduce those interest rates, and you can do that with any number of things too. I don't know, Randy, do you call? I do once a year. We'll call various people and say, it could be the cell phone or the cable or whatever. I'm paying this particular amount of money. It's a little too much. What can you do for me? Even with car insurance rates, it seems that they're somewhat negotiable. Have you ever done that?
Yeah, of course. And I think the car insurance, the homeowner's insurance, and all that stuff, yes, you need to check that from time to time because insurance companies, they base their rates on their past claims experience. When they start seeing their accounts go negative or they see the expenses start to go up, they're going to make sure they can refill their coffers. And we want to be sure that if we're paying for insurance, that it will work and they can actually pay the bill if we have a claim, right? But you need to check that to keep people on the straight and narrow. And the simple fact is you may just be with a company that has, this is true with health insurance, or used to be way back in the day with health insurance companies, they would go in, they would open a book of business, and over time, and we see this currently even with Medicare supplement plans, they open a book of business, they bring a bunch of people in, they enroll them, but over time, as those people die, the pool gets smaller and smaller, and the people get more ill and have more problems as they age, and so it pushes the price for the remaining people higher and higher and higher. So, yeah, you need to check all that stuff and always be sure that you're getting the best deal for what you desire.
Randy, if somebody's already in a liquidity crunch, what's the very first step that they should take?
Yeah, so the first thing would be, if you're kind of in a quandary and you've looked at this and you're thinking, man, I'm scratching my head, I don't know what to do, give us a call. Come in, let's sit down and let's talk a little bit about it. But the biggest thing is we're going to find assets that we can turn into cash and help you get through this problem. Now, again, I don't know what that situation is for everybody listening here today. But again, the biggest thing I would think is if it's something that if we have a crunch where each month we are coming up short, we got to look at what is it we can do without and what do we actually need to keep here. And then let's also look at, can we liquidate something to pay off a debt that makes sense? Or once we paid off one, how can we accelerate paying off the other debts that may be causing the cash flow crunch? So it's just everybody's different. Every situation is different. Let's talk about it. Let's figure out what we can do to help.
Right. The first thing is to have a plan. And certainly we're offering that here at Floyd Financial Group. To get yours, 417-889-7233. There is no cost. There is no obligation. We'd be happy to talk to you about liquidity issues. Who knows? Maybe we'll call out to your house, look around and find some things to sell. You got that old motorcycle over there you've had since 1978. You haven't ridden it since 84. Let's go ahead and get rid of that. But in all seriousness, we are here to help you. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. Randy and Jake, let's take a break. When we come back here, we're going to be talking about financial moves to make before year end when Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to talk about some financial moves we can make before year end.
And year end is going to creep up on us before you know it, guys. It's the middle of October. Just November and December is left. We're in the final stretch of the year. Why do the last 2 months matter so much when it comes to personal finances and retirement planning, do you think?
Yeah, so there's a lot of things that maybe people haven't thought of. January comes around and we think, okay, we'll do this at a certain time. Then all of a sudden, wow, we haven't done that yet, and it's September, So a couple of things to think about. If you've had a good year in business, or if you've gotten a big bonus, or you're going to get a big bonus before year end and you know that's going to happen, one of the things we might look at is in your investment portfolio now, if you have something that's in a brokerage account outside of a retirement account, is there some tax loss harvesting we can do? Have we got an asset class that may not be doing as well as we thought and we have a loss there? Maybe we want to use it to offset some taxes, and maybe that'll help you to offset maybe some of your loss there. Really get you back whole. It could in some cases like that. So there's a lot of things like that to look at, like all the Schwab accounts that we have. You can go out and you can look at your cost basis and you can see where you're at and where you're upside down or not. If you want us to help you with it, don't hesitate to call. We'll be happy to do that and help you kind of walk through that and see if it makes some sense to maybe help you get into a lower tax bracket, or maybe not to pay any tax on some of the gains you've had elsewhere. The other thing you can do is you can do charitable giving. One of the things to remember is the only time that charitable giving is really going to help you is if you have an RMD and you want to do a QCD, or you can exceed the standard marital deduction, because if you don't, you're not going to get any additional credit for that. So sometimes it makes sense to do and sometimes it doesn't. Now, obviously, I think that charity makes sense all the time.
Yeah.
That and tithing at church and
Sure.
giving to missions and that sort of thing. But certainly it's something we could review and see if that would help you or not. We also have You can do Roth conversions if you want to. That's not going to help you much with your taxes this year. In fact, that may even put you into a higher bracket. In fact, it could be that if you've had a lean year and you're looking maybe to convert, it might be a good year to do that. Because, again, the thing to think about on the Roth IRA, we have to have it open 5 years and be past 59 and a half before we can take out all the withdrawals tax-free. But remember this, that they go by the tax calendar year. So if I put in a contribution right now, or if I do a conversion right now, I get credit for a full year between now and the end of the year, and only got 4 years remaining. So that's something to think about. Finally, if you have flexible spending accounts at work for your healthcare program and that sort of thing, or if you need to go ahead and finish funding your 401k, your IRA, if you want to up your contribution to really round out your 401k, you can certainly do that before year end. That's something that you can do. I'm just trying to think if there's anything else. I mean, those are the big ones right there that make sense. And there may be some other things out there that would make sense for people, but those are the big 4 that we would talk about.
Talk about some of the most important tax-related moves that people may want to make here in the final 2.5 months of the year with Randy Floyd Financial Group. You talked about the marital deduction, Randy, and we're talking about this tax deduction. A lot of people don't itemize these days because the deduction is so high. Isn't it around, what is it, maybe $30,000 a year if you're a married person filing jointly, something like that?
Yeah, Jeff, that's about right. Also, if you are up there in years, you get an extra deduction of about $2,000. And then you also, if you're over 65 and on Social Security, in 2025, if you're filing in 26 for 2025 and you turn 65 in 2025 or older, you get an additional $6,000 per person. So your standard deduction could conceivably be in the $44,000 range for the average 65-year-old couple, which for a lot of people will have a similar effect to having no taxes on Social Security, simply because it's going to drop you in brackets all the way down there. So if you're making $50,000, $60,000 a year, by the time you take those standard deductions and factoring in the fact that not all your Social Security was taxable to begin with, you're probably not going to pay any taxes at that level. Now, again, I'm not a tax expert, but we do have quite a lot of knowledge of how taxes work for people in retirement. And I think people are going to be shocked how much difference that's going to make this year when they go to file taxes in 26.
And Jake, you mentioned the phrase up there in years. When you said that, I had to chuckle a little bit there because Randy and I are kind of looking at each other. We got this standard deduction, and didn't we get the extra, Randy, this year or not? I don't know how I feel about that.
You guys are just overqualified. That's all it is.
The one thing that should maybe be pointed out is they do phase out the additional $12,000 per married couple at $150,000.
Okay.
All right. In income, but for most people, it's going to be a pretty nice tax windfall. It's going to get a lot of people out of paying any taxes on Social Security.
Well, there we go. We're back to talking about taxes again. People are driving off the road, but it's important. And we're talking about things to consider here before year's end. And year's end, I mean, it's 2.5 months away right now. So let's continue this conversation, Randy and Jake. What about retirees? What should they focus on as the year wraps up?
Well, I think they should be sure, number one, and we do this for all of our clients here, that they've taken their required minimum distribution, because if you don't, it used to be a 50% penalty. So in other words, if you had to take a $10,000 RMD and you didn't, they charged you $5,000 because you didn't. Now it's only 25%. It's still $2,500. And I don't know about you, Jeff. I don't want to pay the government anything I don't have to, right?
Sure,
so we make sure that the RMDs have been taken. Also, if they are looking to make a charitable contribution to a church or a charity of some sort, we can also help them to navigate that. And again, you can do up to $100,000 if you want to. You can do this and not ever hit your tax rolls. So really a good thing in some cases for people to do. It's just a couple things to be sure that you do. If you want to do that charitable contribution and not have it show up in your tax rolls, do the QCD. But always for sure do the RMD.
What about health insurance coverage, Randy? I know getting close to the end of the year, there's a time when we start seeing all these commercials about Advantage plans and so forth. If someone is on Medicare and they have the different plans or the parts of that, is there anything that we should review towards the end of the year to make sure that we're covered the way that we want to be covered?
Yeah, so hopefully most people will have some agent that they're working with. If you did buy it offline and you don't really have an agent, you can go out to Medicare.gov, and you can go out and look at all the plans. If you've had a change in your health status, now what do I mean by that? Well, let's say that you've had some type of a major event in your life. Maybe you've got renal failure coming up. Maybe you've developed diabetes. Maybe you've developed a heart condition and you've got new medications you're taking. There's certain plans that work better for certain conditions than others. And certainly it's something that you should review, and you can review it online or you can get with a professional that can help you sit down and really navigate what the best plan for you is. Even looking at the cost of drugs across different plans will be different. The donut hole itself is around $2,000, meaning that once you've spent that out of pocket in a year, you're going to pay only roughly about 5% of the prescription drug costs for the rest of the year. That number used to be a lot higher. But again, you need someone, and we have someone here that we can refer you to that can help you to navigate that, but you definitely need to look at that.
Randy and Jake, what about business owners or self-employed folks? What should they be thinking about right now?
Yeah, so year end's coming around, so you need to be thinking about, okay, is there anything that the business needs that I can purchase now that will help reduce my tax burden for the year? I mean, sometimes that's computers. In today's world, it's a lot of times computers and maybe some office furniture, maybe a little change to the office that you need to do. But there are many things that you can do that can be written off and deducted in a year. Now, there's other things that take longer. Some are 5 years and some are much longer than that. Funding retirement plans before year end is something that you'll want to look at, make sure that you've maximized and done all that you want to do there. In today's world, a lot of people don't realize that if you're over 50, you can contribute to your 401k. You can put up to 30 grand, a little more than 30 grand in there a year. So if you've had a good year and you're looking to mitigate some taxes and boost your retirement plan, let's let the federal government pay for some of that, right?
I agree.
Rather than 100% on you. Because once you give them the money, you ain't ever getting it back. Let me put it that way. But that's just some basic things. And there's many others for small business owners that we could look at that probably are outside the scope of what we're talking about right here today.
Randy, for the average listener who feels a little bit behind, what's the simplest step that they can take right now in October and in November?
Yeah, so, start with a year-end financial checklist. Make sure that you've kind of looked at everything and are there any last-minute things you need to do? And then I would say this, be sure that you're looking to next year and having a plan as to what you're going to do next year, because that is crucial to look forward to and to figure out how you plan to navigate next year and what your tax situation is going to be. Many times people come in, they throw their stuff out on the desk and they say, be gentle. And of course, it's a foregone conclusion as to what's going to happen on your taxes then. But tax planning is a real thing and can help you a lot in achieving your financial goals.
Well, like it or not, Randy and Jake, I looked at my calendar and I believe it is correct. It is showing me only 2 more pages after the one I'm on right now before we ring in the year 2026. Boy, hard to believe 2026 is around the corner. Remember, Randy, when it was like 1985 and you couldn't even imagine we'd be alive in 2026. But here we are. But anyway, if people do have questions about anything we've talked about today in our radio program, including things to be prepared for here during the last couple of months, give us a call here at Floyd Financial Group. We'd love to talk to you. No cost, no obligation. Our number, 417-889-7233. You can make that call right now if you want. Leave your name, number. Ashley will call you back, and we'll set up a time for you to visit with us here and get your questions answered at no cost. 417-889-7233. Of course, you can also check us out online. You can see the smiling faces at FloydFinancialGroup.com. Well, Randy and Jake are out of time for this week. Thank you so much for your time, but most importantly, I want to thank our great listeners for joining us. So for Randy and Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.